Okay, so welcome. I wanted to talk about some housing trends that I've been seeing. And really, what kind of got me into this was I read a report coming out of kind of a nonprofit trying to make a case for rent control. And while I didn't really feel like they did a good job, trying to make a case for rent control, because I feel like supply and demand in the housing market has been pretty good, where rents go down when supply goes up and things like that. We've had pretty good balance there. There are things that I think that could be done, as far as you know some things to kind of help keep renters safe and their kind of equity and their how much they're paying, and to kind of keep renters safe. But I feel like rent control is probably not one of them. But reading that report really got me thinking, because there was a lot of data in there that was true, even though I feel like they didn't really make a good case for what they were trying to do. But it got me thinking about this trend that they kept bringing up and what they were seeing. So I wanted to bring that to you. And let's see. So, because I feel like this trend that we're starting to see now in Q3 2021, I feel like this is going to affect us heading into 2022. And so I think this is something that we need to be mindful of, and kind of watching how these trends play out. So let's kind of dig right into it. I wanted to show you guys this. Basically, this is what I call institutional investor mania. So this is a trend that I'm seeing, which is basically the rate at which institutional investors have grown in the real estate market. It's pretty much accelerated at a really fast rate. So far, there has been a $5 billion influx of capital by institutional investors in the real estate market. And their focus is snapping up single family residential homes, which right now is in short supply. And so they're really trying to build up their rental portfolios, and they have a really bullish outlook on single family rentals. And they're even more optimistic going over to the next 6 months. So they've been really working on building up their portfolios. They've been buying homes directly from home builders. They've been buying whole subdivisions. They've been really aggressive at purchasing these single family homes. And if you are a buyer's agent representing buyers, you may have even lost out to one of these kind of investment firms or portfolio companies, because they are offering 20 to 30% more than market value in some communities. So it's something that you need to keep an eye on, and really start educating your clients and say, hey, this is a trend that we're seeing. And as you can see here, I kind of have this list on the screen about, who are the players in this new rental trend that we're seeing. And so at the top of the list, we have here, these are the finance providers that are financing some of these big projects. We have Finance of America, Flatiron, Fund That Flip, Builders Capital, and then we have institutional investors, right? That are building out their portfolios. They're the ones funding and buying houses, and they're creating these kind of joint ventures with property management companies and people to manage their portfolios, right? To manage that asset in the portfolio. So we have crowdfunding platforms. We have single family rental operators. So these are the operators that are partnering with these institutional investors. We have developer operators, right? So we have even some builders, and we have new companies coming into this market that are building to rent, right? We have Lennar Homes and D.R. Horton are two of the biggest home builders that a lot of people know that they build to sell. They build to sell to Joe Q Public. Well, they are now changing their business model and they are building to rent. So that's something, a trend that we need to keep an eye on. Let's kind of talk about that more, about build to rent. So we have, this is called BTR. So if you hear BTR, it means build to rent. So this new BTR trend is growing. And like I said, Lennar, D.R. Horton, and many other new players in the market have added this model to their business plans. And so far this year, Lennar has committed $4 billion to ramp up this build to rent business model. And if you're a real estate agent, you're thinking, what the heck? We have a shortage of supply of inventory for our buyer clients. We have people that want to buy homes. Why are they building to rent? So maybe if you can answer that question, let me know. But I know why, because it's profitable. The hedge funds had started doing this back during the Great Recession when we had all those mortgage-backed securities that failed. All of those houses went into foreclosure. A lot of these investment firms like BlackRock, Blackstone, a lot of those companies you saw on the prior slide started purchasing these foreclosure homes and adding them to their assets. And they needed people to manage their assets, and they wanted their assets to cash flow, before they thought about selling them. So, because they originally bought them to hold. And so they're like, but we can cash flow this. So they created some property management companies. They started renting them, and they realized that, hey, we're actually making a pretty good ROI. We're making a good return on our investment by renting it. Maybe we don't have to sell these right away. So they analyzed it. They said, wow, this is really great. And they started buying more. So throughout the years, the amount of homes that these investment firms own just keeps growing and growing and growing. And so that's a portion of our single family home inventory that is off the market, and it's not coming back because it's sitting in these investment portfolios. So now we have inventory gone. We have super high demand right now because interest rates are low, and we have this backlog of building because lumber, for so long, there wasn't that huge demand for buying homes. And so lumber companies just weren't producing, right? Lumber companies were actually like shutting down and letting people go because companies weren't ramping up, right? They were still a little nervous about building all this new construction, or whatever reason that they weren't putting in these orders, and they weren't trying to sell and develop these new properties. I have some theories about that, but I don't have the data to support it, so I'm not going to talk about conspiracy theories. But let's kind of move on to the next section, right? So we have built to rent, we have low inventory. So we have this fundamental shift in builders and other people coming into the market building to rent, not building to sale to our clients. So let's take a look at who is doing this, right? So we have all these companies on here, capital investment companies, property management companies doing joint ventures so that these investment companies can purchase these single family home assets and these other companies can manage them. And it's billions to trillions of dollars coming into our market right now. So we have Rock Point Group partnering with Invitation Homes. We have Koch Industries, the infamous Koch brothers, partnering with Amherst. We have JP Morgan. We have Alliance Bank of Arizona partnering with Avanta, which is a hunt company. And I believe, and somebody can correct me if I'm wrong, but I believe that's a construction company. So they're probably looking to build to rent. And Aris Pretium, Front Yard Residential. Over here on the bottom corner down here, we have Tennessee Consolidated Retirement Systems partnering with Pretium again. So we have this this kind of joint venture happening. And so we have all of these different companies, billions to trillions of dollars coming into the market. And we have these single family homes being bought, and they're in this holding pattern. And so they're not coming back to the market anytime soon. So a portion of our inventory is going there. So with all of this kind of happening, I'm seeing it, and it doesn't matter like what market that you're in, housing market, stocks, whatever. If you see an influx in capital, coming from institutional investors, it's going to naturally create a bubble. So I'm seeing a pricing bubble that could be happening over the next couple of years. Now, when I say bubble, I don't want everybody to freak out, because what happened last time with like that housing bubble from the mortgage-backed securities, that was bad fundamental real estate. And when you have bad fundamentals and you have a bubble, the market ends up crashing like it did. This is a little bit different because our fundamentals are good, and all this excess capital is cash capital. It's not bad loans coming into the market. So we're seeing, it's just a little bit different. So what I could be seeing is, with all of this capital coming into the market, with all of this kind of high demand, equity rising, when they're done spending their money, I see a pullback maybe in pricing or flattening out in pricing. I don't see a huge crash coming, but at the end of this slide, I do have kind of like a perfect storm that could create possibly something, not really a crash, but really a lot of inventory that could cause that pullback in pricing. And we'll talk about that more in the last slide. But so that's kind of what I'm seeing. I'm seeing prices are going to be increasing over the next couple of years, a bubble. I'm also seeing residential clients will continue to battle investors for current inventory. Inventory is already low because demand is so crazy high. And inventory is already low because over the past 10 and 15 years, builders never ramped their building back up to get to like pre-recession numbers. And so again, we didn't have these new homes coming to the market at the rate we did before, for whatever reason, out of caution, out of who knows what. Again, I have my ideas. But so we didn't see new construction coming to the market. So we already have that low inventory from all the homes that never got built over the past 10 to 15 years. And then we had this really high demand from the historically low interest rates. So we're seeing that like perfect storm of, oh my gosh. And it's going to take some years for investors to kind of, or not investors, for home builders to start getting to the point where they can build enough to kind of catch us back up. But it's going to take some years for us to get there. And even with that taking years, if some of these builders are changing their model from build to sell over to build to rent, that could fundamentally kind of change those projections out for that inventory, because they're not building stuff for us to even buy. They're just building rental houses. So that's going to limit how much inventory does come back onto this market. So reduced inventory will be available for residential buyers because of this fundamental shift in business model from building to sale to building to rent. B, from having all of those houses that never got built over the past 10 to 15 years, plus this super high demand from low interest rates and demand from all of these institutional investors coming to the market. It's creating just a massive shortage supply of single family homes. So it will take some time for these builders. It took us 10 to 15 years of not building houses to get to this point. It's not going to happen overnight for us to get out of this inventory situation. It's going to take some time. We could start seeing some inventory come by 2024, before the builders have enough lumber and they start optimizing their production. But even then, it's going to take some years after 2024 to start kind of seeing this happen. So resale outlook for the next year or two, definitely going to be short supply with all of this institutional and domestic kind of demand. What I'm concerned about the most is this excessive capital coming into our market from these institutional investors. So we have, like I said before, anytime there's a lot of liquidity in any kind of market, it's going to create this kind of pricing bubble. So that is concerning to me, that we have all of this liquidity coming into the housing market. And what is that going to do? It's going to drive up the value of housing. And I do have some concerns there, because that really does mess with affordability, even though, interest rates are low, and you're still getting maybe a $1,400 mortgage, but the house costs more, and that might be okay for now. But another thing that we have to keep in consideration is property taxes. So if we have this excessive capital driving up prices, and then the assessor's office says, oh, your house is now worth $500,000 and it was worth like $150,000 before, and your taxes go up $300 a month, that's going to affect a lot of people. So we need to really keep an eye on that factor of affordability. And we need to keep an eye on a future decrease in rental demand. So if rental demand falls and these companies cannot get renters into their assets, into these portfolios, they're going to start selling off their assets. And so we have to keep an eye on that happening. Because their whole thing is getting profit, right? And turning a profit. So they may keep increasing rent. You just don't know. And rent could get too high, and then people are like, I can't afford it. And they're going to move in with mom and dad. And then they're going to like, oh, maybe I should go buy a house. And then they're going to realize housing prices are really, really high, and they can't buy or rent. And like, people are living with family members. They're living with mom and dad. They're coming. And so there's like this yin yang effect of affordability that could really stagnate both of these markets. And I'm a little concerned about that. And then excessive supply, I'm a little concerned about. And this is what I was saying earlier about, like, there could be this perfect storm of supply coming that could, really turn the market. But I don't see this coming anytime soon, but it's just something that we need to keep an eye on. So what this could be is all three of these together down here, is that we see excessive short sales and foreclosures, distressed homes coming to the market. If we see excessive new construction supply, like they finally get their act together and start building all these properties, and institutional sell-offs. So if we get this stagnated market, like if everything's too expensive and people don't want to pay to rent, or they can't afford to buy, they can't afford a down payment because they've been paying so much high rent, we'll start getting these institutional sell-offs, and those rental properties will come back to the resale market. So that is what I would consider a perfect storm: a high foreclosure rate, a ton of new construction supply, as well as these rental properties coming back to the market, along with our normal inventory, right? And so if we're starting to see unaffordability happen, and people get really high tax bills, and they can't afford to even pay the taxes on their properties, then we could start seeing those types of sell-offs too. So, and that's kind of four things. I should probably added another bullet to that, but that is what I feel like could be the perfect storm of this market shifting from this crazy seller's market to a buyer's market. And I feel like it's not going to happen like overnight. There's no way that any of these things on this list are going to happen in the next 6 months. I see this as a long-term concern with what's happening in our market. So that's what I have for you guys. Again, this is the trend that I'm seeing. I feel like we really need to stay on top of this. We really need to keep watching this. If you're a real estate agent in a market and you're seeing, competition from these cash institutional buyers offering 20 to 30% over market value, and your clients aren't getting homes, comment, let me know. Are you seeing this? This is a trend that I'm seeing. This is concerning to me. And so I think it's just something that we need to keep an eye on. I don't have a lot of data on this, but I think it's something that I will be watching for sure. So thank you so much for tuning in. I think this is, again, a trend that we need to keep an eye on for 2022.